Hi guys, welcome back to the channel. I hope everybody's doing well out there and had a fantastic time over Christmas. Today's video I'm going to be revealing what's inside my stock market portfolio, as well as giving you a bit of an insight into me as a person and my investment journey over the last 4 years and try to summarise that. I'm 30 years old, I'm based out of Scotland, and between 2016 and 2018 I was self-employed, working between 45 to 50 hours per week, and over this time I was able to save up about £60,000, mainly due to the fact that I was still living with my parents at this time. So with this money, what do we do with it? Do I pay down the house, get a larger deposit? Do I invest? If I'm going to invest, what do I invest in? Is the stock market the best opportunity? Isn't that for crooks, as it's portrayed in Hollywood? Or is property the best route to go down buy-to-let routes? At this time I had no idea and what I was wanting to do with this money, so I began my research, and ultimately over a few months I decided that the stock market was going to be my vehicle of choice in building wealth. In 2018, I took the plunge to begin my stocks and shares ISA journey. As it says here, I had no experience, and when I said no experience, I had zero experience. I had no idea what a balance sheet was, what a PE was, market cap, and I'm still recovering from some of my early mistakes, which I'll probably make a separate video on this to help you guys out there. The current market value of the portfolio is £91,500, and of the capital I had invested, it's about £19,000 gain, or about 26%. And this is what the point of this video is. It's about showing the journey that I've had from someone who was picking poor stocks and poor companies to the portfolio that I've got now, which still has some of my earlier mistakes, but I feel that I've got a real spine, a real infrastructure in place now to build out from. 2021 was a really defining year for me as an investor. Firstly, I created this YouTube channel to help share my experiences, to show exactly what life is like as someone who is looking to build wealth through the stock market and buying individual stocks. I also found my identity and what type of investor I'm looking to be, and it's a bit of a hybrid. I like value companies, I love the dividends coming through when I'm looking to build out about 60 to 70% of my allocation in value stocks, with the remaining 40 to 30% in high growth stocks. These can be highly profitable companies, as well as a few spec stocks in there, as I feel that with these kind of risk versus reward situations, growth stocks can really be the key fundamental in trying to outperform the market. I also received over £2,000 in dividends this year, which when I look back on over previous years, this was really a pipe dream, and I'm really over the moon and hope to build upon this in 2022. I rebuilt the backbone of the portfolio with blue chip companies. Previously I was invested in poor companies, which were just real poor decisions on my behalf, and I need to hold my hands up on that one and take it on the chin as well and say I got these wrong. And with further due diligence, researching more into what stocks I should be buying and what I'm looking to get long-term return-wise and how I'm going to get there. What I've got in front of you just now is 4 years worth of information of the deposits for each of the years where the portfolio was standing at the 31st of October 2018, and the reason I've got this as October is because the next one would be the end of January due to Hargreaves Lansdown issuing his quarterly reports, and January would be the latest one, which obviously we don't have as of yet. So we had £20,000 deposited in 2018, ISA allowance was fully maxed out, and the portfolio was down about 10%, and the reason for this, and I'm not proud to say this, was because I just started investing and I thought the stars were lining up for me nicely. I was just new to the market. The cannabis stocks were the latest hot topics. They were going up 10%, 25% every day. And I thought, imagine that. Perfect timing. Here's me coming along, and here's this huge opportunity with this red hot market, this new sector that's coming into play here. And here's me coming along. What a perfect opportunity. And well, I guess you can kind of read between the lines here. I went pretty much overweight in cannabis stocks, which crashed and burned, which some of them I'll show you within the portfolio. Next year, I put in another £20,000 to max out the second year ISA allowance, with a portfolio value of about £38,091, which was down almost £2,000, about 4.3%. So this was an improvement based on the previous year, but it's still in the red overall, so not great. 2020 was a rough year for all of us as COVID hit. I put in another £20,000, so I had £60,000 invested at this point and was down £10,000, almost 20% of the value of the portfolio. And the thing is with this had actually recovered a good bit, as during the COVID lows I was down about 30-40%, in fact probably closer to 50 if I'm being honest with you. Imagine how you would feel. You put £60,000 in, it goes down to £30,000 or £25,000. But I know in the long term, this is for me, this is the route that I'm going to go in, and I will succeed on it. So into 2021, we've got the 31st of October 2021, and by this time I had added in another £12,500 to the portfolio, and we had this huge run up in stock prices. The market was starting to perform. Everything was starting to align. Now I was picking higher quality companies. I was succeeding well, and now the portfolio stands at about £92,000 as of 31st of October, which was a gain of close to £20,000 of the £72,500 invested, giving me an increase of wealth of about 27%. And this is the journey here. Obviously the stock market performance was a key factor, but the reallocation of poor stocks of the last few years into high quality companies, which I'll share with you as of right now. So this section of the video is getting recorded as the market is live in action in the UK just now, so you may see some fluctuations in share prices, but right now we're sitting at about £91,500 with a cash balance of £4,873, and we'll go through the stocks and how they're performing just now, and I can show you how much I've paid for them and also the value with the percentage gains as well. So this is in alphabetical order, so starting from the top, we've got Airbnb. I really think the outlook for 2022 is positive. I think we'll get in 2022 what we were expecting in 2021. As travel wasn't back to 100%. It might not be 100% as of next year, but what I really like about Airbnb is they've had record results and they've had profitable quarters, which is good, and hopefully this continues. The valuation does concern me a little bit, so this is going to have to be careful on and work out my exit plan on what I want to do. Is this a buy and hold, or is it going to be more of a trade? Then we have good old Alibaba, a real poor performer in the portfolio. I have been buying this on the way down. The company should perform well over a long period of time, and this is probably the maximum allocation. Usually what I like to try and do now is buy about 2% of the portfolio value and look to add in as the stock reduces in price about 20%, especially with a growth stock like Alibaba. But I'm just about kind of fully allocated. I would maybe do one more purchase, but we'll take it from there just now. But we're still down 46%. Then we've got Alkaline Water Company. This is a small cap company. It's only about $140 million in market cap. I like the look of it. It's a spec stock that I've got in the portfolio, only a small amount of percentage. In the grand scheme of things, it's due to report revenue growth of about 20-30% for the next few years, but it is still loss making. It was at 100% earlier in the year, but only time will tell. We'll hold this one for the longer term and see how the results perform. Then we have Alphawave IP Group. This is a UK based semiconductor company who specialise in their IP connectivity to help the likes of Samsung and Taiwan Semiconductors. Bit of headwinds regarding this about how they do their business. But I thought the actual business model they have is pretty solid, and they have very high margins from the revenue that they currently bring in. Down 20%, but I wouldn't be surprised if over the next year if this goes into the green, no problem at all. Then we have Altria Group. Altria have bought these for their strong dividend payment, about 7.5%, and I'm good enough to be up here on about 13% of the initial cash invested. And we've got Amgen next with 10% gain, or almost 11% gain from the initial position. Good dividend payer as well. Apple, no words needed to describe what these guys do. £1,800 capital invested, and we're up almost 50% in this, so this is a real good one for me. BAE Systems, defensive company, lower position, about £1,600, and we're up almost 14% with a strong dividend payment of 4% or 4.5%. Who aim to appeal to the 18 to sort of 30-year-old age group. Over the last year, their share price has been absolutely decimated. It's down about 50 to 60%, and in the last few weeks I've seen this as a really opportune time to initiate a position here. So we've got about £2,400 invested, and we're up almost 6% in this short period of time. Then we have BP. I couldn't have picked a worse time to initiate a position in this, as I picked them up about February 2020, which was right before the COVID pandemic sell-off began. And that was a real poor time within this individual stock, but I did average into it, and as of right now we're not too bad, down about 3%, and we do get a nice dividend from BP. British American Tobacco, these maximise the allocation for tobacco stocks. I'm kind of toying with the idea whether to sell Altria and go more into British American Tobacco, because I think their smokeless and e-cigarette products are a bit higher calibre with the views. So that's what I'm going to have to think about. But we do get a nice dividend yield of about close to 8%. Canopy Growth Corporation. So here we go. This is one of the biggest lessons that I was talking about, down 83%. This was when I thought that this was going to the moon. And well, what can I say? I've really learned my lesson on this one. Not quite sure what to do. Do I hold it for another year or two and see if we can get this up a bit and sell out? Or do I take it on the chin just now and use this as a lesson learned? So let me know in the comments what you think I should do regarding Canopy Growth. It's a real poor performer, right up there with the worst in the portfolio, and a real lesson learned for me. Citigroup picked this up within the last few days. The share price has come down and it offers a safe 3.4% dividend yield, down 1%, and I see this going back up to $80 within the next year. Coupang is up 9%. We've got this in the portfolio as it's an e-commerce company based out of South Korea. I think the fundamentals long term in this are going to be superb, and I think over the longer term, maybe a year, 2 years, this will be up well over 50% to 100%. Darktrace share price got absolutely hammered recently. It's a UK based cyber security company, down about 11%. Oh, down 12% as we speak right now. Ouch. But longer term, happy to hold this company. And I think it will perform exceedingly well over a period of time. Energy Transfer, it's a pipeline company. They deal with, as it says on the tin, transferring energy around the US, down 50%. I bought this before COVID as well, and I would love to buy into this one, but for whatever reason, Hargreaves Lansdown have changed the criteria, and you can no longer buy this stock within an ISA, which is a real shame, as I would love to average into this one a little bit more, as I think over the next few years it would be a real good performer. Then we have GAN, down 41%. This stock has been performing pretty poor as of recent, with the share price down heavily. But it was up earlier in the year, and it's another one that I'm going to hold for the longer term. Due to the small market cap and the high volatility, there's no reason why I can't see this going back up to 20% over the next 6 to 12 months. GlaxoSmithKline, UK-based healthcare company. This is going to get split up into two segments. So this dividend of about close to 5% is probably going to be getting reduced down a little bit as it spins off next year. Greencore Group, this is pretty flat for the year. This was bought as it's a UK based sandwich ready to go food provider. I feel that this is going to be a real good performer for 2022. We'll hold on to it and see how it goes. I'm not quite sure what I'm going to do with the exit strategy on this. It's not a buy and hold forever, but if this was good enough to take up about 30%, I would probably liquidate the position. Iomart Group next. This is a company I've done a video on about a month ago, where the share price had come down about 50%, and over the last month I've identified this as a good time to enter into the stock, and as of right now, in the short term, we're up 7%, and it does offer a 4% dividend yield. Then we have Lockheed Martin, one of the largest aerospace and defensive companies in the US, up 5.5%. Nice dividend yield as well. Medical Properties Trust are a healthcare REIT in the US, up close to 20%. Strong dividend payer as well of this company. Merck, up 5.5%. Good dividend payer. Micron, up 30%. This is a real good uptick in the last few weeks and months, so happy to see that. Money Supermarket, picked this up earlier in the year, and it was down close to 25% over the last few weeks, but it's been turning up a little bit. It's paid a strong dividend if it keeps the payout at current levels, and there's no reason for me to believe that over the next 12 months this won't be back up at £3. New Residential Investment Corp. This is a mortgage REIT US, and these are historically known to pay out high dividends, which is one of the reasons I've got it in the portfolio. Done my due diligence on it, and I think with the recessed share price that I picked this up at, it's one that I think will perform good over the next few years. Up 7% just now, 9% dividend yield, really happy to take that. Organon, I got these three shares when Merck spun it off earlier in the year, down 14%. Not really got a lot to say on this one. It does pay a dividend, but I'll probably look to sell these as they don't really carry a lot of weight in the portfolio. We've got Palantir up next, down 23%. This is a buy and hold, minimum 5 years for me. Let's see where it goes. It's got a really interesting business model. The company's got high aspirations as well, so want to keep an eye on it. It was up earlier in the year, but over the long term. And then we've got Pfizer in the portfolio, a huge performer here, of about 66% gain, close to £1,500 profit, and I need to work out what I'm going to do here with the exit strategy. They do pay a nice dividend. Right now it's about 2.7%, but I've picked this up and I think it's about close to 4.5%, which is really fantastic. But for me, I do need to work out what I'm trying to do with this stock. Is this one I would look to take the winnings and deploy this into a stock which maybe isn't performing as well, or hold it in cash? So I need to work out exactly what I'm doing. In years gone by, that's the kind of strategy that I was deploying, rightly or wrongly, was selling the winners when they reached a price that I was happy with, reached my expectations over a period of time. Then we've got Raytheon, up 30%, happy to hold this one. Not a huge dividend payer, but they do offer a small payment of about 2.4% as of right now, and I think I've got these close to 3%. Royal Dutch Shell, as with BP, I picked these up on the exact same day, back in February 2020, down 10%. If this does go up, they do pay a pretty reasonable dividend right now, so if this does go up to even or plus 10% over the next year, I would probably liquidate this one as well. Then we have Sativa Wellness Group. As with Canopy growth, this was at the time I thought the cannabis stocks were going to the moon. I would end up a millionaire overnight, and guess what? We didn't. We're down 86% on this one, and this is another one where I need to work out what I'm going to do with this. Is do I just take it on the chin, take the losses, and look to redeploy this capital of about £500 into the higher calibre stocks that I've got now? Then we've got SoFi. SoFi was up earlier in the year, down 20%. Longer term, happy to hold it. It's going to be a good performer in my opinion. Superdry, another huge mistake, and one that I'm learning from, because back then I literally just bought this in 2018 because it's a company that I knew about. I didn't do my research into how I thought it was going to perform long term, and guess what? It's been an absolute terrible performer for me, and another one that I've learned my lesson on, and to do my research more into the longer term prospects of company and realise that just because you know the name of a company doesn't mean that the fundamentals are strong. Then we've got Tattoo Chef, down 5%, happy to hold that for a longer term. Ventus, another healthcare REIT, down 20%. This will go back up over the period of time to about $60 or so. Probably one I would like to get out of the portfolio. It's not the highest of calibre of stocks that I've got. Then we've got Vodafone, a real love-hate relationship. It's down close to 20%, but it does pay a very high dividend yield. And when I take into how long I've held this for, about 3 or 4 years, because of the dividend payments, it brings my total returns probably to about bang on even. And lastly but not least, we have Walgreens, up 20% based on the initial cost basis, good dividend payer. And if you look at this right now, we're down 10%. And if I can quickly just go up to the top here and show you how the poor stocks that I picked earlier on when I started investing, Sativa, Canopy, and probably Superdry, these are the only ones that I would be looking to sell. That's about £7,500 right there, which really affect my total returns. When I flip this the opposite way, you can see that over the last year, the companies that I've been starting to invest in, higher quality companies offering good results. And the thing is, if these went down 20 or 30%, absolutely, I would be buying more of these. And the last thing I would just like to try and quickly cover off here in the next minute or so is just to cover off my dividend journey over the last few years. 2021, hugely successful year, over £2,000 in total coming through in passive income through dividend-based stocks, and this has worked out an average of about £177 per month. We've had some highs of 252 and we've had some lows of £66, but over the course of the year it's had a strong return of £177.34. If I can show you the comparison of the start of the journey, back in 2018 we had a total income of £83. I had zero experience in what I was trying to achieve, how I was going to do it, what are dividends, I had zero clue. And then these payments started to come through and I went, you know what, this could be a real fundamental strategy that I'm looking to deploy here and getting cash to come through the door. I don't have an unlimited cash pile, and if I could get dividends to come through each month, this can help supplement some cash that I can add into the portfolio. 2019, things are starting to pick up a bit of momentum. Most of that year was based around dividend and value stocks, with a high of £308.40 just to the way that some of the companies paid out as they were UK based high yielders, and this gave me an average income of £63.09. Then as we move forward into 2020, we started to pick up some real steam here. We had a total value of close to £1,500, exceeding £120 per month. And you can see the increase here. On average, things are going in the correct direction. And if we go back to as we are right now, that £2,130. So really delighted to show my journey here. I hope you've got a little bit of insight on some of the things that have went right, and more importantly some of the things that have went wrong and how to avoid these situations. And I hope you found value in the video overall. So thanks again guys for watching, and I will catch you all in the next video. Cheers.